Hey there, it's Jonathan here for Rich Retirement TV, and today I want to tell you why you need stocks. As you can see, I've got guitars here on the wall. I'm an analyst and writer by day, but on the side I play music in a big way, and I'm all about using the right tool for the right job. I've got Les Paul style guitars for big body tone when I need it. I've got Stratocasters for when I need to, cut through, or for something more classic rock vibe. I've got a different guitar for each style of music, but I know that each one gets used for where I need it. And stocks are very much in the same way. They're the right tool for a lot of people, but they're misunderstood, especially by retirees. So today I want to break down the wall, and show you exactly why you need them and how they can help you live a rich retirement. So let's go ahead here and kick things off. So I want to break this down in basically four charts. Moving out of the way. There we go. So the four factors to consider as to why you need stocks are simple. The life expectancy, inflation, interest rates, and the return of stocks versus other asset classes. So when it comes to life expectancy, Americans are living longer but have less money saved up than ever before. If you head to the Social Security Administration's website, they've got an expectancy calculator, so you can roughly see at whatever age you are, based on your birthday, how long you can expect to live. And for a 65-year-old male, it's about 18 years into the future. And for a female at 65, it's about 20, almost 21 years. But here's the thing. Most Americans have less than $1,000 in their savings accounts. So a study here by Go Banking Rates found that nearly 70% of Americans have less than $1,000 in savings, and a whopping 45% have $0 in savings. And if you're in this camp, I know it probably feels terrible, but there's hope. We're going to talk about that today. But that's a big one. All right, so the next item here is inflation. Inflation is the silent killer of savings. Every year, the dollar, the greenback, as we know and love, it loses value every single year, and the average rate of inflation is about 3.2% over the last 30 years or so. That may not seem like a lot, but every single year, your $1 on average is worth 97 cents the following year, and as you can probably tell, that compounds. So after a while, if you park your money, let's say, under a mattress, eventually not only is that cash going to rot, but it's going to be worth a lot less. So you've got to get your money working for you. And as you can see here, we're looking here at the CPI index, which is one of the consumer price index. It's one of the most closely watched inflation indices in the U.S. And it's steadily rising. Right now, over the last couple of years, inflation has undershot that average 3.2. I think on the year in 2020, we're targeting barely 1%, if at all. But inflation is always a risk. As many of you know, in the 1970s and 80s, inflation skyrocketed after a period of low inflation, and that can easily happen, especially as stimulus gets poured into the economy and more money is created. That leads to greater consumption of goods and services, and that's going to push inflation higher. But this yellow line here, so we've seen the white line, which is the CPI index, but this yellow line, that is the inflation of medical services. and that has outpaced the rate of inflation by a whopping margin. So while inflation may be low on a headline level, there are the two biggest costs associated with retirement are housing and medical. And medical, both of those have outpaced inflation here for some time. So essentially, what you've got to do with your money is you've got to grow it in excess of inflation. So you've got to, a good target is you've got to earn at least 3% on your money in order to be able to keep up with the pace of inflation. But that leads us to point number 3, interest rates. You've probably heard a lot about interest rates over the last couple of months here in 2020 because the Federal Reserve, which is the major driving force on interest rates, they cut rates here in early 2020 to combat the coronavirus crisis, and it's great for stimulating the economy. It brings down borrowing costs. If you're buying a home or you're taking on debt for a business, it's going to help you in a big way having rates be low. But there's an opposite effect on savers. So folks who have money parked in a savings account, they're earning less on their dollars, they're earning less interest on their money than that. So right now we're at almost zero on the federal funds rate, which is the Federal Reserve's interest rate, and that's the rate that every other interest rate here in the U.S. is set off of. So you're lucky to in a checking account be getting 0.1%. You'd be lucky even in a high yield savings account to get 1%. So in a savings account or even some CDs, you're getting 1%. That's enough to get you through a year or two of very low inflation, but that's not even close to overcoming that hurdle of 3.2% on an average basis. So if you have money that's in a savings account, you're not earning enough to outpace inflation over the longer term. And if you have zero savings at all, you don't even have the ability to put that money into a savings account. Probably starting at a very, very big disadvantage to living a rich retirement. So that's where the stock market comes in. So here's a chart it's a really good chart here of the return of stocks versus bonds, gold, and U.S. home prices since 1980. And as you can see here, stocks outpace pretty much every other asset class here on the chart by a very wide margin. And it's actually very simple. Why? As interest rates come down, asset prices go up. All asset prices. But that effect is particularly pronounced in the stock market where companies are borrowing money to generate these large businesses, generate sales, and create earnings. And generally speaking, the lower interest rates are, the lower the borrowing costs are for companies, and they're able to generate earnings. So that all gets transferred to shareholders in the form of stock price or dividends, or the combination of both. But here's why it's so important for folks that are approaching retirement or in retirement who are behind on their savings. Stocks rise on average 10% every single year when on a total return basis, meaning the gains you get on the stock and in the dividends. So you're in the stock market, you're able to put your money in, and yes, there are ups and downs. There are volatile periods. even crashes like we've seen in 2020, 2008, 2001, and so on and so forth. But on average, and this is since 1970, this goes back, stocks are returning 10% every year, including, and that includes bear markets and crashes and whatnot. And it's also the single best way for somebody who doesn't have a whole lot of experience, doesn't have a whole lot of capital, to put it to work and actually generate big returns without having a whole lot of know-how. Now, fortunately, here at Rich Retirement TV, you've got a wealth of experts who are breaking down stocks for you. And I've got a couple of tickers for you here in just a second. But there's no better way for you to put money to work for you than the stock market, and it's accessible to everybody, especially in today's world where we've got online trading with no commissions now. So there's a very, very low barrier to entry here, and I can tell you, anybody can do it. Anybody can do it. You don't have to be a serious math person. You're going to want to know good businesses from bad businesses, but generally speaking, it's stock investing. Actually putting your money to work is easy. Picking the good stocks, that's the harder part, but that's where we're here to help you. So now that you've seen why stocks are so important, you're living longer, you need more savings, interest rates are low, so you're not making any money in a savings account, and stocks offer you the best return, the biggest bang for your buck than any other asset class here in the United States. Let's take a look at some tickers that I like right now. All right, so the place to be, the sector that's going to see the biggest return over the next say 10 to 20 years is technology. Technology has transformed our lives in ways that we couldn't even count. But what's so great about tech stocks versus other stocks in the market is it doesn't take a lot of overhead to create a great tech company. I mean, Facebook is a social media network. It doesn't have a whole lot of hard assets. Most of its profits are generated on software, right? Intellectual property. A couple of guys and gals in a garage can start a tech company and generate hundreds of thousands of dollars, if not millions of dollars in profit in a short period of time, because it doesn't require a whole lot of capital to get into. So these stocks are very, very, very explosive in terms of their gains. They can move higher very quickly. So these are good stocks to, if you're looking to catch up quickly, these are great stocks to do it in. And right now, this is a ticker that I really like. This is Crown Castle International, and they're kind of the best of between tech and dividend stocks. Dividend stocks are fantastic for owning shares and then taking in you get paid for owning those shares. And over the long run, dividend stocks can really through the magic of compound interest, as Warren Buffett would say, can really put your money to work. So over the course of like 10, 20 years, reinvesting in dividends, they can add up. But what I like about Crown Castle specifically is that it crosses the world of tech and income, because it's what's known as a real estate investment trust, and it's Crown Castle International is the largest operator, the largest cell tower operator in the United States, and they are an integral force in the 5G technological movement, right? As we move from 4G to 5G, Crown Castle owns a lot of the land that the cell towers are located on, that were beaming these signals back and forth. So the Crown Castle is a big company. They pay out a very generous dividend right now. Their stock's yielding about 3%, and they've really, take a look at this chart. It's been had some ups and downs in the shorter term, but the stock is trading at almost just below an all-time high here, and the trend for the stock has been undoubtedly up. Just since 2017, where the stock was trading about $80, or late 2016, the stock has more than doubled over the span of 3 years, and it's again paid a very, very healthy dividend. This is a great stock to get you exposure to tech and get you paid for owning those shares. Let's take a look at our second stock here. Another tech name. It's Microsoft. And for most people, the Microsoft needs little introduction, right? It's one of the biggest, most well-established tech companies in the world. I mean, their Microsoft Windows operating system is installed on the overwhelming majority of PCs in the world, both on the consumer side and on the commercial side. So a lot of businesses, they order PCs in bulk. Those PCs come with Microsoft Windows already installed in that whole host of services like Microsoft Office. That's all bundled in there into a very cohesive environment. And what's really the driving force here behind what's going to take Microsoft into the next level for them is their suite of cloud services. So if you've ever heard of Amazon Web Services, that's one of the biggest cloud computing spaces. You can basically write computer programs and put them onto the cloud instead of having them on a server, say somewhere. If you're a company, you basically put your application on Amazon's web services, and it beams down to millions of users around the world. They've been a leader in this space for a long time, but Microsoft has a competing service called Azure, and it's geared particularly towards business, and it's gaining a lot of ground, overtaking AWS, which is short for Amazon Web Services. And excuse me, again, it's adding to Microsoft's host of services they can offer consumers and companies. And again, this is a fantastic tech company. They also pay a dividend, but they're more. What I like about Microsoft is they're a very big, mature company. So while smaller tech companies can be volatile, while these companies can be volatile, they are the bigger, more mature companies like Microsoft. They're much more stable. They don't, because they have heavy institutional interests from like Wall Street or very big investors. Their shares don't move around as much as, say, a smaller tech company. And the final stock on our list is a big one. I covered it last week in the video on COVID Kings, but it's Lowe's Companies Incorporated. And again, if you own a home like I do, Lowe's pretty well. I've got one right down the street, and my wife practically lives there. But while people are stuck at home because of COVID-19, they're at home. They're making their homes nicer. They're making the spaces that they live in nicer because they're spending more time there. Or in the case of my wife, she's a big gardener, so she's constantly going out there and getting stuff and working on the garden outside, or working on her flower garden up on the deck. So as soon as the business opened back up to in the course of reopening, she's been going back, and that store's been popping. The same thing with Home Depot. What I really like about Lowe's is that they're what's known as a dividend aristocrat. They've paid a dividend for 56 years consecutively. They prioritize giving back to their shareholders, and that's the kind of stock that you want to own. It's a real good ballast in your portfolio. Because again, the dividend stocks, over the long run, they actually outperform non-dividend paying stocks. So if you, let's say you've generated money in the stock market and you want to start moving it towards something more stable, Lowe's would be a great name for you. And while a lot of other retailers are prone to getting their, or they've seen their shares decline through the crisis, Lowe's has held up pretty well because again they sell products that you can't just. A lot of people want to go in there and touch them and see them versus, say, Amazon can ship you a lot of stuff, but if you're going to buy a, say a chainsaw for hedging or whatnot, you probably are going to want to go see that, and that's where Lowe's comes in really handy. So yeah, three great stocks here, and again, Lowe's, and three great stocks here. We got Lowe's, Microsoft, and CCI, Crown Castle International. These are great stocks to get you started if you're just kind of getting into the game and looking to catch up. These are three great ways to do it. Or let's say you're in retirement and you're just looking to supplement your income and maybe put stimulus check to work that you didn't necessarily need. The stock market is a great place to make that money grow until you actually need it. But again, stocks are very important, and they're the right tool for the right job if you're looking to boost your retirement savings and you're behind. Single best way to do it. But yep, that's what I've got for today. Thank you so much for watching today's Rich Retirement video. And for Rich Retirement, I'm Jonathan Rodriguez, and I'll see you next week.